Good afternoon and welcome to our halftime portfolio and economic update. I'd like to take a minute and review our mission statement. It's our mission at YBSP to guide and empower our select clientele to make informed decisions regarding their wealth so they can make an even greater impact on the people and causes they care about deeply. Yerba Buena Financial Partners follows a proprietary process called the Wealth Impact Process, a disciplined approach that we have created to provide our clients with personalized service of the highest caliber.
For those of you who have not attended our webinars before, welcome. Everybody, welcome to everybody. We like to structure these things by us taking a look back of what's happened during the period. We'll be going all the way back to the beginning of the year here, so we do a whole first half update. So where we've been in that first half, where we are now, what are we observing presently, and where we may be going. Obviously, no one knows exactly where we're going, but we'll talk about some of the things that we're watching and some of our thoughts there. Before we jump into the presentation, we like to just do a few kind of, what do I want to call them, trivia questions. A lot of it from pop culture, so to get your minds working, right? So who delivered their last monologues as co-hosts of the Golden Globes? So you see the options there. You think in your head who you believe the right answer is, and then Sally's going to show us.
The award goes to
Tina right? So they're done. They will not be hosting that show anymore, and I think a lot of people are happy about it. So the next one, we'll just do a few of these. Which popular television series is signing off after a final season? Parks and Recreation, Mad Men, or Late Night with David Letterman? Or all of the above, right? Sally, which is it?
All of the above.
All of the above, right? I know nothing about Parks and Recreation and Mad Men.
Other than Amy Poehler, in both of these.
Yes, she is, right? And the Late Show with David Letterman is way past my bedtime. And
Mad Men has just
I never see
wonderful sets of an era.
The costumes, yeah. Okay, great. So what rule changes did the NCAA approve for men's basketball? So this is kind of a big deal. So did they make the shot clock 60 seconds? Did they add more timeouts, or did they change the arc of where the three-point line is? I'm sorry, where the defensive zone is under the basket, not the three-point line. Or none of the above? Sally? Yeah, so they changed the arc under the basket. They actually did change the shot clock from going from 35 seconds to 30 seconds. And all of everything that they're doing is an attempt to get the game moving along faster, less timeouts, higher scoring, right? So it's all for excitement. So that's enough of that, right? That's the fun part of everything. Every quarter we are having a guest speaker and guest writer for our monthly newsletter. So I want to welcome Kevin O'Keefe to the group. Kevin, welcome. Kevin and I did an interview a few weeks ago, and that was the featured article for our monthly newsletter, the Mint Edition, which you should have received last week. If you're not receiving our weekly market commentaries or our monthly newsletters, please let us know so we can get you on the list, or if you know anyone else. I've known Kevin now for 5 years, right, Kevin?
Right.
Kevin has a lengthy background. I'm not trying to make you old or anything. Kevin has a lengthy background in the fixed income markets in general. Kevin's done a lot of work in his past. In relation to loans, credit in general, of all sorts and varieties. For the last 15 years, Kevin's been focused on residential mortgage market. So Kevin is going to be able to bring that perspective to us throughout the webinar. So we'll be involving Kevin in that webinar, in those questions throughout the webinar. But for right now, let's move along and start talking about, where we've been through the first half of the year. And Andy, one of the things is, of course, everyone has been watching the markets and what's been going on in the markets and all the volatility. So can you take it away from there and talk about the markets a little bit, please?
I'll start where we've been with the markets, and we're starting here with a picture of a deflated football. As made the news, and it was such big news, was Tom Brady and the Deflategate. So that's kind of how the markets feel, is how that football looks today. And I think that the Patriots are happy to pay $1 million fine, lose a couple of draft picks for the value of the franchise increasing as a result of winning the Super Bowl. Kind of how the banks behave, but that's for later in the conversation. So the market to date, it's been kind of flat this year, as you can see here. The light green number is basically showing that the Dow Jones is, hardly done much. The S&P actually went into negative territory for the year again today. The markets aren't doing much of anything.
Well, quite a bit of volatility. If you look at that center line, there has been quite a bit of up, down, up, down. So
right. As far as
ending up nowhere, right?
Right. And as far as volatility goes, statistically over the last 7 months, volatility has increased by 20% per trading day, which means that the swings are larger, which we've certainly seen in this last couple of weeks as it started again. This slide talks about GDP, and it's basically telling us that GDP is slower than we might like in terms of what's happening in the U.S. right now. It has slowed down since it peaked in the Q3 of 2014, and we're waiting for some numbers to come out, and then we know when those numbers come out, they get revised again
right
a few months later.
Even these will get revised again that we're looking at here. The data has to catch up with the government.
So so why are things slower in terms of GDP? There's a couple of reasons here, as the slide says. Lower oil prices, U.S. dollar gains, decline in exports, slow wage growth. Bruce and I were talking earlier, as we talked about in our previous webinar, that's not up on this slide right now, was all that emphasis that was on the weather on the East Coast and then the port closures on the West Coast. But these things are just slowing GDP. It's just
it does seem that the U.S. dollar gains has been probably the biggest influence on what's going on with the economy here. A lot of the companies that have been reporting earnings were at the end of current earnings season, so many companies, especially international companies, are talking about how the gains in the U.S. dollar have really affected their profitability.
Mm-hmm. So when we look at GDP in Europe, compared to that which was happening in the U.S., I think we could see that in the Eurozone in general, it's pretty flat, though there are a couple of countries that have done quite well, including Britain and Germany and Spain. Here in terms of the estimated GDP for all of 2015, based on what's been happening so far in the year.
Okay.
What's that?
Quite well?
Yeah. Well, relatively strong.
Oh, because that speaks to the stagnation that we're in. If we're thinking that 1.5% growth is quite good, yeah.
So as it slowed in
Spain's the only one that's showing anything of significance.
So as it's slowed in the U.S., it's accelerating in Europe.
Okay. Central banks, the European Central Bank, took on a lot of what the U.S. Central Bank has been doing ever since the crisis. So they have made their attempt to at quantitative easing, and we have seen that the euro has come down quite a bit since they started this. So their original intent seems to be working. They're trying to improve their exports at the same time in doing this. I think they should be careful of what they ask for, right? If they get the euro to parity with the dollar, they're going to start having other problems with deflation and what's going on in Europe. So I don't think they want to see any of that. But needless to say, they are being very aggressive. During the first half of the year, the Swiss National Bank really put their foot in it when they decided to completely change their markets and their credit market, and that just shot the Swiss dollar through the roof. I mean, that has really hurt a lot of people doing business in Switzerland quite dramatically. They've seen increased layoffs. I mean, it hasn't helped. I think that'll settle down pretty quickly, though. But it's getting so ridiculous now, Kevin, this probably interests you, right, that they have negative interest rates in many places in Europe, right? Negative interest rates.
Pay me to borrow.
Pay me to borrow, right? So here's a story of a woman who is actually getting paid to borrow money. And so why are they doing this? Everyone asks us, why the heck are they doing such a thing? And the simple answer of it is, and it is a simplified answer, is that the central banks are trying to encourage people to take risk, right? They want us to take risk by either investing in the stock markets or taking out loans in order to open businesses, grow your businesses, whatever it may be. They don't want that money just sitting around not working, which is why if you put money into a savings account in many places in Europe, you're actually paying for them to store your money, right? So you're not even, we complain about interest rates here being pretty much zero on your savings account. Now think about if the bank was actually charging you to store your money there, right? Which is what's happening in many places in Europe. So that's an interesting phenomenon. The European stock markets, they showed some signs of life there for a while in the first half of the year. That's waning now and coming down with what's gone on. We'll talk more about what's been going on the last couple of weeks a little later in the webinar, but suffice it to say they're coming back to the same growth rate that we've had here with the stock markets in the U.S. Which brings us to interest rates, Kevin. What's going on? What did you see as far as mortgage interest rates in the first half of the year?
Something near and dear to my heart.
Yes.
Basically, rates have been flat. They've been moving between 3.5% and 4% for the last 6 months. They creeped up a little bit in the last couple of months, 4.25%. Talking about a 30-year fixed rate on a standard mortgage. Okay. But they are still historically very low. They have not been terribly volatile in the last 6 months.
Right.
So that's basically what's going on. The chart basically shows that.
And then how much of these gyrations in rates has it affected the housing market in general? Right, I mean, you're seeing a bunch of people try and jump in all of a sudden, and then they're rushing. I mean, what are you seeing?
Well, you're seeing a couple. You're seeing a couple of things. One is that there is very little inventory in the market,
right,
particularly in California.
Right.
Two, you're seeing prices go up fairly rapidly because of lack of inventory, and that raises other issues or other problems for borrowers. One is they start being hyper aggressive. They need to try to have a very fast close, and they run into valuation problems. So it's not a fun time to be a buyer in this market,
right,
in California.
Right. You're seeing everything get bid up
Exactly.
Dramatically, right? And then just to sort of anyone who's on the listening in right now, so when we hear interest rates, mortgage rates go down, right? You go down, a quarter point or something like that, like you've been talking about. And then someone says, okay, well, I want to jump in and get that rate, right?
Right.
So if they don't already have an application in, how likely are they to be catching that rate?
Fairly unlikely, because basically rates will move a quarter point in a couple of days. More likely it's an eighth of a point. But it's going to take somewhere between 30 and 60 days to process most refinances, not purchases. My company now will do a purchase in 17 days. and we stick to that. But refinances and most other lenders, you're talking 30 to 60 days for both purchases and refi. So your chances of picking the lowest possible rate that shows up is pretty small. And what you're better off doing is get your application in, get it approved, and then wait till you see the rate you want, and then nail that rate.
So, in the interest of time, we need to move on.
Sure.
But you just bring up one thing. So, if someone has their application in, how long is that application good to be sitting there, right? If they don't find the house they want in the next 90 days, or rates aren't where they want in that 60, 90 days, are they going to have to start all over again?
Here's what they have to do. Basically, the application is good until withdrawn, except things in that application get old. So once a document is somewhere between 30 and 60 days old, that document has to be updated.
Right.
That's the issue.
Okay, thanks. All right, we'll get more from Kevin in a little bit. Bank of Japan is also doing its own quantitative easing, right? They want to get in on it. It started working. They were doing pretty well with it. They saw the need to do it again. So just like the Wile E. Coyote there, always trying, always trying, always trying, the Bank of Japan keeps doing it. The problem is that there's so many other factors going on in the world economy, not least of which is what's happened to commodity prices, which we have seen a full-on bear market in commodities across the board. That just didn't help Japan trying to get their inflation rate up. They're going to continue. I don't think that Mr. Abe over there is going to stop doing this. It worked for the U.S. It seems to be working for Europe. Japan has been in 20 years of stagnation, so I think they're willing to try anything. But they certainly have been very aggressive. And it's helped their stock market a bit, but we'll have to see how they handle what's going on in Japan and everything else that's going on in the region as well. And then we come to China. You know, Andy, you and I were talking about China earlier this morning and everything going on in China, and there's a lot to talk about when it comes to China, not least of which is looking at if you look at the Chinese stock market over there, it's enough to give you whiplash with the amount of volatility. We're talking about volatility here. I mean, they've been having swings of up 5%, down 5% any given day.
It's a serious roller coaster.
Yeah.
Over there. And as you and I were talking about, one of the things that we just don't know that we can trust data there, which is,
Right.
One of the reasons why, as our clients know, is we don't invest directly into China. I mean, there is some exposure through a couple of ETFs there, but we're not buying individual companies, especially in light of some of the information that I think we're going to cover a little bit later that comes up here. So given that the market goes up, everybody's enthusiastic, the market crashes there, it's just way too volatile.
Well, part of what is going on in China as well is that they're trying to get more and more of the people in lower socioeconomic statuses to be able to move out of the rural areas, to be able to buy some sort of
fill up those cities they built that are in
to invest in the stock market, to try and grow wealth, right? So they have a similar phenomenon of what we had going on in the 90s here, the 1990s, where so many more retail average people were investing in the stock market. And they get all excited. They're not the most educated or rational people about the stock market. And so that's going to create a lot of this in and out and volatility. And when that bubble bursts, we're concerned that a lot of those folks who are trying to move themselves up out of poverty in China are going to get hurt.
And there's definitely going to be a global impact to it.
Right.
No question.
Government bonds have been all over the place, and I just love this graphic over there because it is enough to make anyone just put their head in your hands and say, what is going on?
If Dobie Gillis could see it now.
Yeah, right. So, why is it been so volatile? Kevin, I don't know if you have an opinion about the volatility in the bond market at all.
I do have an opinion, but
One that can be expressed in public?
probably not. There are a couple of interesting things going on. One is that, yes, the bond market has been very volatile, and the arguments there are because of computerized trading
Yeah.
and some other things along those lines. Certain banks being out of the market, not making a market anymore. That's one thing.
Yeah.
What we're seeing on the mortgage bond side, however, is very different. What we're seeing is a very solid market and an expanding market with new players coming in every month.
Mhm.
That's a good thing for borrowers.
Mhm. Great.
Yeah, I think
Do you want to?
yeah, I would agree with that. I think it's the lack of market makers which creates the lack of liquidity, which is,
Right.
why we're seeing this volatility and price declines.
We have some people who completely dismiss that as an issue, and I find it interesting. I mean, if the government or the Federal Reserve is no longer in QE and buying, if the banks are, by regulation and Dodd-Frank, are not out there doing their own trading in the bond market anymore, who's going to pick up the slack? Where's that going to come from? China doesn't seem to be buying much of our debt anymore. As a matter of fact, last week China sold a bunch of our debt to increase their own liquidity. So this is still to be played out, right? And so that's pretty much what we have seen in the past, 6 months or the first half of the year. We want to try and now take it into where we are today. A lot's been going on in recent weeks with everything. One of the funny things, Andy, is the American Justice Department going after FIFA.
Right. Well, they didn't have too much success with Tom Brady, and they didn't have a lot of success with the chief executive officers of the banks. So they're going after FIFA because it's the same criminal activity.
Probably a lot of the same people.
Probably a lot of the same people, most definitely. So, but they're trying. So again, I mean, if you're going to be fined $150 million so you can make $1 billion, you do it every day and twice on Sunday, and they're still doing that.
But economies trying to grow?
Yeah, the economies are trying to grow. Relative economic strength of nations here. I mean, the quantitative easing has helped a bit. We could see here that unemployment is still pretty high in Europe. If we just go backwards in this slide a little bit, inflation is high in a bunch of places, including Brazil mostly. And GDP is weak. I mean, it's looking pretty good in India, and in China, which we just talked about, we don't know if how valid the numbers are, but
right. But when we look at unemployment and these numbers here, and different countries calculate unemployment differently, but when I lived in Europe, it was during the economy was doing incredibly well when I lived in Europe, and unemployment in France was still 8%. So it's about what's the new normal, right? Is the new normal for them now going to be, much higher than that? I mean, what's going to happen when it comes to unemployment? Here you see that unemployment is up around 11%. For people who are younger in Europe, it's twice that, right? Now, how long can this go on before we start to see a lot of civil unrest? Now, we've been talking about this on webinars for a few years now, when we haven't seen that unrest. Now here, when unemployment is 8%, it's absolutely unacceptable, right?
Right, and we talk about the labor participation rate, which is one of your favorite subjects,
right.
That those numbers really are skewed.
Right, which I didn't get for us, but it's still, the labor participation rate in this country is still back at 40-year lows, back to the late 70s numbers.
Yes.
And then there's Greece.
Greece is one of your favorites. Well, we've been talking about kicking that can down the road.
So the night before last, evidently, all of those brilliant folks over there were up all night, and they came to a quote, final agreement, unquote. Final, I should say, quote, final, unquote, agreement, right? Because it's not going to be final, just like the last one wasn't final. But what I read this morning about that deal was, it appears as though Greece is going to be fine now with their creditors for 2 to 3 years. So we can expect this ugly monster's head to re-expose itself in another 2 to 3 years, because there is really no way for Greece to be able to handle the amount of debt it has. They can't manage the taxes over there. The people just don't pay the taxes. Right?
So it's a bigger can being kicked down.
Being
a
kicked
longer
down the
road.
road.
Right. So,
And then we come to our rate hike game over here, which I don't know.
sure, I mean, we've been
Kevin has something to say about that.
Yeah, and we've been talking about it in June, we've been talking about it in the fall, when it's going to happen, and Janet Yellen saying, well, maybe, maybe not. There's a lot of, in my opinion, I think there's a lot of overreaction to the rate hike. I think it's, and that having a rate hike and getting it done, the first one, and then just letting things stabilize would probably be good for the economy. That's just an opinion.
Well, that's
And the psyche of all the people who are affected.
just to
by it.
get it over with,
Right.
just raise the darn rate a quarter point, just get it over with. So, and get, I wish you would just come out and do it and say, now, everybody, just go back to work and stop just being obsessed about this silliness.
But like you and I have talked about for so many years, there's this overreaction like a pendulum.
Yeah.
With rates. So,
Wow.
so the idea of, so if they raised it by a quarter of a point and then left it alone, they can't leave it alone. They have to keep raising it. They just have to keep acting. They have no self-control, and they're totally reactive to the situation.
Yeah. I heard a funny quote the other day that the Federal Reserve doesn't create boom times or boom markets. It only kills them, right? So we're people who believe around here the Federal Reserve just goes, the pendulum on them on either direction goes too long, right? So did you have any thoughts, Kevin?
I don't disagree with you at all. My thought is that you're going to put a lot of talking heads out of business as soon as they do the
Right.
quarter
Sure.
point. They won't be able to speculate anymore. It'll actually happen.
No.
And then they'll just speculate about the next one.
Right, and this is what they do for a living, and that's just how they can get their appearances on CNBC and, get paid for that. Now, I did see an interesting article today on Bloomberg that if anyone is interested, you can go look up yourself, where it is saying how the Chinese government is actually doing Yellen's work for her, right? They may not need to raise rates, because when the Chinese devalue their currency, they're hurting us, and they're helping Chinese exports and hurting our own exports, which is going to make our trade deficit even worse than it already is, which is going to create some inflation over here. And so people are saying they might not raise rates if China keeps doing what they're doing.
It's also going to reduce our company's profitability.
It is.
So that will slow our economy,
So
And it's going to take away jobs.
and it will take away jobs. Exactly. And it'll keep rates low.
and it'll keep rates low. So careful what you ask for. And then let's get into the China
Since,
talk.
since we're talking about
Yeah.
China there, and we were talking about the devaluation of the one that, again, is totally unilateral move, a month before the talks when President Obama is going there to talk about a big trade agreement. It seems fitting that they do this. But apparently there's some information where companies in China just keep changing their names and the objective and what their companies are
Yeah.
and what they do. And so, again, it comes back to us that we don't know what to believe
Right.
there. So, buyer beware, we're not buying.
Well, so as you said, right, so we used to invest our clients' money in some limited Chinese companies. And after a few years of us doing that and reading financial reports, realized we can't rely on any of the financial statements coming out of these companies. So it's important for our clients to know we no longer buy individual stocks on Chinese companies. We're involved in some of the
Exchange traded
other
funds.
investments.
Can't say those words, sorry.
That's okay.
And then there are other companies that are U.S. companies that actually invest in China, and we have that exposure there.
Right. We're going to talk more about China here in a few minutes, but now we also have a current issue going on around the country of raising the minimum wage and trying to decide what's the right thing to do there. And the arguments on both sides of raising the minimum wage are quite compelling. We don't want to get into that argument, if you will, here. We don't have enough time, and it brings up so many social and cultural and political issues, so we don't want to get into that. But it is something that we need to watch because this could greatly affect the profitability of companies in the U.S. If their labor costs are going to go up dramatically, and in some cases it could be doubling their labor costs. Labor is already the largest expense of a business in most cases, especially small businesses. And if their labor costs are going up dramatically, one of two things is going to happen. We're already seeing this up in Seattle, right? Either prices are going to have to go up, or some people are going to lose their jobs. We can't have it both ways, right? Because some people are going to have to close their businesses. And this may be what we decide, if you will, as a society, or our politicians decide for us. But we're going to have to watch that, again, when it comes to the profitability of the companies that we're investing in. And then we have, well, commodities in general, but oil and oil prices. And I know, Andy, you had a couple of thoughts about what's going on with oil.
Yeah, I've been tracking oil. I think that the change in the prices of oil are going to have a significant impact globally in 2015 on all the economies. We're seeing it happen now. I think that for those of us, the consumer at the pump, it's great. It costs, it'll cost a fraction of what we were paying before. And that's a good thing. It could be good for manufacturing plants that have reduced costs to produce. It could be good for the airlines, right, and creating profitability. But it's not good for the oil companies. It's not good for either the big behemoth oil companies or those new developing oil companies that, companies that have been working on development in the Midwest and the new mining and extraction and the midline companies, which if the price of oil stays low and OPEC continues to pump the way they're going to pump, and if Iran floods the market with more oil, those companies are going to go out of business, which means that there's going to be unemployment, greater unemployment, which is going to affect housing, right? And it's going to affect government spending to help these people. So, good news is bad news and bad news is good news. So the lower price of oil is good in some ways and not good in others. There's some interesting statistics just about oil that, just in terms of its pricing. So in 1950, it was $25 a barrel. It stayed pretty low. In 1975, it was $50 a barrel. It went up to 114, remember that, in 1980, right? Iran-Contra. It went down in just before 2000. In 1998, it was down to $11 a barrel.
Wow.
In the not too distant future, not too distant past, in the last couple of years, it was up to $143 a barrel.
Yeah.
And now it's down to 43. People were using numbers like 70 as a long-term stable number, but nothing is stable and flat.
Yeah.
And today it's at $43 a barrel.
Right.
And again, it's great when I fill up my car, but it's not necessarily.
It's good for the economy, right? So that's great stuff. And no matter, there's some people who really hate the oil companies, right? And so let that be, right? Some people really hate the oil companies. We have to recognize that the oil industry, all the way up and down the supply chain of oil and gas in this country, employ a lot of people. And in the last few years, that has really been the boom of the employment that we've seen in so many of these areas. And if now we're taking that away, that's going to affect the overall economy. So whether you love the oil companies or hate the oil companies, it can affect you as well.
No question. It's also going to affect all the R&D in alternative energy.
Right.
Because there's no incentive for companies and people to do that if a price of a barrel is cheap.
Correct.
So we will see.
So this next one is a quote from Jim Rogers. Not a big fan of reading to people, but this I think is an important quote as we look at what's going on with the United States vis-a-vis the rest of the world. The 20th century was the century of the U.S., the 19th century is the century of the U.K., the 21st century will be the century of Asia, and it's becoming more and more evident, and especially of China. So that's according to Jim Rogers. And if we start to think and look and really absorb what is going on in China and what they are doing, it should really smack all of us in the forehead with the realization that China's not just sitting back waiting for everybody to help them to grow and become a reputable force in the world economy. So you see here where the Asian Infrastructure Investment Bank has been formed. And the amount of countries that are participating in it is now up to 57. And if you look at it, you might think, oh, it's a bunch of despot countries from, communist, socialist, or tyrannical countries in the world, or just Asian countries in the world. Well, it's not. There are a lot of our allies on this list.
And
the only
democracies,
the only significant allied democracies you don't see on there are, of course, us, Japan, Mexico, and Canada. Now, how long till, Mexico, as an example, can hold out and not do that? So China is not going to just sit back and say, well, it's okay, the U.S. isn't taking a leadership role here in Asia. We'll just wait for someone to take a leadership role. Now, Japan or China is saying, oh, we're going to take that leadership role.
And I think China's definitely flexing their muscles in a lot of ways, certainly here, in terms of this creation of the Asian Infrastructure Investment Bank. And you and I were talking earlier about how, is this their attempt, not that it would necessarily come to fruition, to have a new world currency not be the U.S. dollar? Right? Because that would certainly have a significant impact. And I think it is part of that attempt, whether it'll come to fruition or not.
Right.
So between this and the flexing of their muscle in the China Sea.
Yeah, we'll talk about that, but just so we can finish on like the monetary policy thing. No, they're starting to require more and more the trading that's going on with them, especially the trading that's going on in Europe, in Asia, to be traded in the yuan. I mean, that's what they're trying to do, and they're trying to be pretty aggressive and forceful about it. So we'll see, and that's a part of the reason that people can't trust what's going on in China, and I don't think that it will ever become the world currency over the dollar, in large part because you can't trust what's going on. I mean, if they can come out overnight and just by fiat devalue their currency by 2%, and then it's lost even more since then from the markets, how can you trust and make that a world currency where you can just arbitrarily do something like that? Until it's completely floated, their currency, till it's completely floated, there's no way it can become, I don't think. Now, what's going on as well, and you started to talk about it, Andy, sorry to interrupt. I don't hear a lot of news about what China is also doing just in general about its being a power force in the world, and what they're doing throughout Asia and intimidating their neighbors, intimidating their trading partners, taking reefs and artificially expanding reefs in the South and East China Sea, and then building military bases on our reef out in the middle of the sea, and then declaring that their territory and a 12-mile territorial zone around it, and then start intimidating and threatening anyone who comes near it. I just don't think that we're hearing enough from politicians about this issue in the world. And Japan is being very, very aggressive out there. Donald Trump, right? Okay, so we're talking about current events. So Donald Trump, like him or hate him, we're not going to get into that subject. The fact is, he's pretty popular right now in the polls, and I think in no short part because of this issue right here. Why aren't our politicians doing something about, or talking about, or raising the red flag, about what's going on in China and how aggressive they're being all over the place? So yes, so this is something that we're definitely going to have to be keeping an eye on as we go forward, as we decide how we're investing our clients' money.
Great. We'll now take a quick intermission break for 3 announcements. We invite you to connect with YBFP on LinkedIn and Facebook to hear comments from our advisors on the weekly market commentary and Mint Edition, read news, and watch new videos regarding YBFP and more. We also invite you to visit and subscribe to our new blog available through ybfp.com, where you can hear the frank comments of Managing Partner Bruce Frankel on topics geared toward accredited investors and entrepreneurs. You can read topics such as playing defense in business and passion for your business, but not for finances. Lastly, we'd love to see you in our office before the end of the year. Please call or email to schedule your annual reviews for 2015 today. And I'll turn
Great.
it back to Bruce to
Yeah,
review
thanks,
our
Sally.
models.
Thank you, Sally. So our models pretty much dictate everything we've been talking about up till now. But Andy, can you take us through the progression here from the end of last year?
Yeah, so once again, for people who have not seen this slide before, this slide represents our most common growth with income model, which would have a maximum of 60% equity exposure if fully invested and 40% to fixed income if fully invested. The blue bar represents equity, and you can see at the end of the year, we were at about 50% long of what would have been 60%. I mean, so that's like we were 80% invested in our equity sleeve and strategy. Right now, as you can see by the color changes, our equity exposure is significantly lower. It is currently at 24% in this model. Our bond exposure is 0, and we're very high in cash. We are definitely, I mean, the point being that we are very much in protect mode right now, and the volatility we talked about earlier and these uncertainties are ones we just don't want to expose our clients' money to. And sometimes it means, you know, we might miss a particular opportunity on one week, but what we've been told by our clients is they would rather miss out on an opportunity than participate in a slide down.
Right. I mean, and you can probably go to the next one, but basically when the risk-reward ratio is not attractive, we're going to reduce exposure to that.
Right.
And be just as mindful as protecting that we are of growing.
Mm-hmm.
And the volatility has been unbelievable. And as you saw from, this chart and the previous one, I mean, you can see on this one where even the bond market, we're out.
Right.
We're out.
We're out of the bond market.
Right now, it's been so volatile in the bond market that we can't, we had the discussion already about all of its.
Right. I mean, the only opportunity that we're looking at right now in the bond market is national tax-free short-term.
Muni side.
On the muni side. National-based, high credit quality.
Right.
Kind of a steady eddy.
Conservative stuff.
Pretty conservative stuff. And what you can see on this slide here as well is that even though there's not a lot of green bars to the left of the one on the right, which is cash, is that we look for those opportunities in a fully diversified manner.
Right.
And this just shows all the different indices or markets or segments of the markets that we can participate in. I am obligated to, because this slide is up, to read a disclosure.
And now from the Compliance Department.
And now from the Compliance Department, from the Columbia School of Broadcasting. International investing involves special risks such as currency fluctuation and political instability. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price.
Great.
Thank you very much.
So to sum up what's going on with our models, we've slowly moved into protect mode over the first half of the year. We are there now in protect mode and will pretty much stay there until we see some stability. Great. So where we may be going, right? And where we may be going, no one knows. So if you see here, as we go through a little bit, you'll see where Larry Summers thinks that things aren't so good. And then you're talking about secular stagnation. So we should quickly say what's secular stagnation. So where we just really don't have a lot of growth. Nothing is happening, right? We've just seen this slow growth model since the crisis. So that's pretty much where we've been. But then again, Mr. Bernanke, the former Federal Reserve Chairman, says that Mr. Summers is wrong. And he doesn't view it as stagnation. It's just basically slow growth. Then you come to other people like the IMF, who the IMF says that things are looking up. And they said that in April. But then we turned around and said that things may be slower than we think. And then Mr. Fisher from Fisher Investments, he manages, I don't know how many billions of dollars, Mr. Fisher, and he doesn't think the bull market is over yet, pretty much because of what's going on with quantitative easing overseas and other things. But then we come to Mr. Gross, and he says, not so fast, right? He says,
It reminds me of
it's just kind of funny.
of the Buddhist saying, which is, for every truth, its opposite is an equally valid truth, right? Everybody's got their opinions
Perspective.
and perspectives, and they're all over.
And agendas, and right, so what is someone pitching and whatnot. So it's, you pay us folks to sit here and go through all that and sort it out.
Navigate this for you.
Yeah, so you don't have to do that. We talked about the Federal Reserve hike, right? We just think that it needs to start happening. You can see here relatively from the past how long these sorts of things have gone on. We're in a long period of time of such low interest rates. I mean, historically low. But of course, then people say, well, this time may be different. Maybe the Federal Reserve will handle things with a smooth landing and we'll be fine. They won't cause inflation. They won't cause unemployment. We'll see. But I wanted to get to this because, Kevin, one of the things that we've been talking about as we work with clients, and you and I are talking, and we talk about what's going on in foreclosures and with the home equity loan market, right? And so many people took out these HELOC loans during the crisis, and just before were taking advantage of the equity in their houses.
Correct.
What are you seeing with all that now?
There are two different aspects to that. One aspect is foreclosures in general, and many of those have been in the works for 4 years. So, for example, I think we looked at a statistic that showed May over May foreclosures were up 16%, according to Bloomberg.
Right.
That may be true, but when you look at what is comprising that change, it is mainly foreclosures that have been in process for 2 years. So that's one thing, stuff that has just been stuck in the pipeline.
Okay.
The second thing is that foreclosures in general are dramatically lower than they were a year ago or that they were 2 years ago. I mean, big numbers, different. They're 20, 30, 40% of where they were 1, 2, and 3 years ago. Now, when you talk about HELOCs, the issue there is that there were a lot of piggy bank borrowing, right, from 2000 to 2006. Typically, those HELOC loans had an interest-only period of 10 years, and then they have to start paying principal and interest over the remaining 20 years of those loans. The issue there is that's now, 2015, 2016, here it comes, right?
Right.
There are also variable interest rates. So if interest rates start going up, not only are people going to have to pay principal and interest over 20 years, interest rates are going to go up, and that's going to increase their payments. Now, this has not shown up as a crisis yet, but it certainly is an issue. It is certainly something we should be concerned about, and this is a great graph because it shows a chunk.
Yeah.
Yeah, it shows a chunk of stuff coming due 2015, 16, and 17.
So the defaults on these will be lagging, right? These
Correct.
numbers here, right? This is just showing when they actually go to principal or amortize, right?
Right.
So there'll be a delayed reaction of the effects of this.
That'll typically
certainly.
be 1 to 2 years.
Okay, that long. Okay.
Yeah, that long.
Right, because if people their budgets are so tight, and then all of a sudden that loan amortizes, oh my goodness, I mean, we're going to start seeing defaults.
Correct. One of the interesting things this chart shows is that we have had some loans coming due 2008 through 2013 or 14. We have not seen a huge number of defaults on those.
Well, interest rates were still low.
Interest rates are still low. Exactly. The other thing that's happened is that typically houses have appreciated somewhat dramatically over the last 5 years.
So here's the question then. I mean, if interest rates do get increased slightly, and this frenzy of valuations of residences, which I personally think is in a bubble right now, ends up freezing or going back to some form of normalcy, what position does it put these people in terms of loan to value?
It gets very tricky. One of the solutions to this problem, obviously, is to refi the HELOC. The second solution is to pay it off if you've got the money. The third one is to roll it in with your first mortgage and essentially create a new 30-year amortization period over the entire package. If you don't have enough equity in your home, meaning there's been a pullback in valuation, as you're suggesting, you can't do any of those things except pay it off.
Right.
That's a real problem.
Plus, the underwriting guidelines have completely changed since those loans were taken out. I mean, we were giving loans to anyone who could fog a mirror back in 2005.
And it's happening again, because the other day on the radio, it was like, take 120% cash out of your house with no questions asked.
So let's start to wrap up, and I'm getting flagged for time here. So what is the trend that you're seeing with that right now, Kevin, and what are you anticipating? Because we're starting to see subprime come back, right? The subprime mortgage scenario and whatnot, and talking about, 10% down, no money down, all these sorts of things seem to be creeping back. Are you?
I am not seeing that among any legitimate lender anywhere in the country right now.
Okay.
You are seeing somewhat more aggressive lending, and by somewhat more, I mean the pendulum has come back 5% from the 180 degrees it was swung at. So it's coming back a little bit. Yeah, yes, there are lenders who will do, on a jumbo loan, 10% down, no mortgage insurance. But I guarantee you that that is a very qualified borrower who's making a lot of money and has a very solid job. And it's a portfolio loan, meaning the bank is loaning its own money. It's not going to resell that loan somewhere else. So yes, we are seeing that. We are seeing certain banks doing variable rate loans again. 5-year fixed, 3-year fixed, 7-year fixed loans, and then a variable after that. We are seeing that come back again, only for borrowers who are very strong.
Interest only?
We have there is one lender who will do interest only right now on one of those variable rate loans. Now, there are other lenders in the market who will do the kinds of things you're talking about, and they particularly love to advertise on the radio.
The illegitimate lenders.
The illegitimate lenders, right. I can't repeat in public what I would say about most of those. Right. But they are lenders who are basically gouging their borrowers. They're charging very high rates, very high points. And they're doing it on a 60 or 70% loan to value, typically. Typically. They're not, obviously some of them are advertising a 95 or 98% loan to value.
To qualify for that.
To qualify, you got to jump through hoops.
All right, well, you made me feel a little better about that. All right. Suffice it to say, as we look forward into the future, we have no idea what's going to happen. I like this picture here. I think last time we showed an economist with 6 hands. Right. And then the joke that I've used before, so forgive me if you've heard it before, is why are there weathermen or women? Why are there weather people in the world? To make economists feel good about themselves. So we don't know what's going to happen. As you've all heard us say before, we're optimistic, always long term, especially about this country. And when one door closes, other doors open up. We want to encourage everyone here, if you have any questions, we're not going to be able to take questions. We're out of time. We promise to keep these things to an hour. Please call the office, 415-334-8000. We're happy to talk with you. Please schedule your annual reviews if we haven't seen you in the past year. And thank you all for participating in everything. I forgot to mention Marilyn is not here today. She's on vacation in like Cape Cod or somewhere. Where is she?
She's on the East Coast. Yeah.
And so we wish her a nice vacation. I hope you all, on behalf of everyone here, I hope everyone's had a wonderful summer. It goes by way too fast. Sally, any closing?
No. Thank you guys so much for participating. And we look forward to seeing you in our office soon.
Great.
Thank you.
Thanks, everyone.